Good afternoon, good morning, based on where you are. My name is Jeff Tucker. We're going to just give folks another 5 or 10 seconds before we get going. So, all right. So again, my name is Jeff Tucker, CEO of Tucker Company Worldwide, freight and logistics company based in Haddonfield, New Jersey, outside of Philadelphia. We've got a presence all throughout the country. We tend to deal with most of our customers, but we deal with temperature control, dry van, open deck, and then permitted, specialized, some of the largest, heaviest, widest, longest loads that you could imagine, and been in business 62 years now. We are pleased today to have Lee Klaskow from Bloomberg Intelligence. And I'll get to Lee in just a moment, but Lee is one of those folks who said this numerous times on these webinars and with Lee in different forums, that one of the people that I appreciate the most in the industry for his perspective as to what's happening especially in freight transportation. And today we're going to be talking a little bit about what is happening, where have we been, where are we now, where might we be going. I just want to give a couple housekeeping items first. I think any questions that you folks have, please use the Q&A on the Zoom. I think we're all 3+ years into this thing. We know how to find the Q&A, whether we'll use the Q&A versus chat versus any other email that was mentioned in the email notification to you. So thank you for that. And then also, please, note your calendar. Our next webinar is June 13th. I'll also ask you to use the Q&A to provide ideas for what our next webinar might contain, and or potential speakers that we might invite, either that one or the next. So we're always open to ideas, always open to suggestions, and we want to make sure that these are most impactful to you who are here. So Lee.
Jeff.
Thank you for being here.
Glad to be here. And I always come back because you always inflate my ego. So,
Well, I appreciate that. It's part of the master plan. Lee, if you would, why don't you tell us a little bit about you and your role there, and then we'll get rolling.
Sure. So I work for Bloomberg, the big media company. I work for a division within that company called Bloomberg Intelligence. It's their research arm. I cover freight transportation logistics for Bloomberg Intelligence, and that includes pretty much all modes of freight transportation. So whether it be trucking, rails, non-asset, shipping, tanker, liner, pretty much anything that moves stuff. Don't really care that much about people, at least the moving of people. Of course, I care about people. I've been doing it here for about 13 years. Prior to that, I've been covering freight transportation on the sell side for about 5 years. So that's kind of my experience in terms of following the freight market. So give it 17, 18 years that I've been following the freight markets. In addition to the actual markets, I cover about 22 individually publicly traded companies, kind of like, the big names that you would think of, like a FedEx, UPS, a CSX, a Canadian National, Maersk, and on the trucking side, the big ones like Knight-Swift, JB Hunt, Old Dominion, just to name a few.
Excellent. And I know already, if you haven't already, you can find Lee on LinkedIn. And Lee speaks not only in webinars like this, but just came back from CN's conference, right? But numerous conferences throughout the course of a year, as a highly sought after speaker. So this one more piece of housekeeping. This is a 15-minute briefing. We're about 4.5 minutes in. There will be up to 15 minutes of Q&A after, and then we will be done sharply at 12:30 Eastern time. So Lee, we've been through a lot, a roller coaster ride in the last 6 to 8 months, let's say, certainly over 3 years. But tell us where you think we are, and the last time you were with us some number of months ago, you gave us a prediction for, or the the propensity of a percentage chance that we would be entering recession as a nation. I want you to fill us in on that as well.
Yeah, sure. So as a company, Bloomberg provides consensus on a lot of different estimates that are out there on Wall Street. One of those estimates is the probability of that the U.S. economy would go into a recession. And right now, that's at 65%. So it's a 65% probability that the U.S. may go into recession. I think there's a pretty good chance that it happens. I do think that it's going to be pretty shallow and quick. I think that, the freight markets are already in a recession. I don't need to tell the people that are listening to this webinar that obviously volumes have been down for quite some time. They've been down for numerous reasons. High inventory levels. For one, has been driving that. Also, really tough comparisons. It's not necessarily that volume is bad. It's just not as good as it was last year. And you have those two things, and that's really weighing on rates pretty much across the board. Specifically on the truckload side, you have spot rates down around 20%. And it feels to us that we are bouncing around the bottom of that. We don't think that it's going to get much worse on the spot market on the truckload side. And the reason for that is that capacity is starting to leave the market. The higher cost owner operator capacity on Werner's. So part of my day job is listening to earnings calls and trying to make sense of them. We were on Werner's call last night, and their CEO Derek Leathers was, who always provides fantastic commentary about the market, was saying that I hope I get this number right. I think 13 to 17%, or I'm sorry, spot rates are currently around 13 to 17% below operating costs. And so, carriers can't operate in that environment long. And so you should see an acceleration of capacity leaving the market, which will really help rebalance things as we're going into a more seasonally strong, stronger environment. You're coming into the beverage season, people are still going to be drinking water and beer this summer. And that's usually a good thing for trucking demand. And then you go from there into, obviously, peak season for the holidays. And so, you have those two things. I think that can even withstand a mild recession. So, you could see spot rates, starting to, maybe go like this in the second half. That wasn't like a dance move, but like go like that in the second half of the year, which, would really, be beneficial for like the large publicly traded companies that are well capitalized, have strong balance sheets, have plenty of cash on hand to weather the current storms. And a lot of those large companies have over the years have been diversifying into less volatile markets, whether it's going into the brokerage business or whether it's going like a Knight-Swift going into the LTL business, which is tends to be not as cyclical or as volatile, I should say, as the truckload market. So you're seeing what we'll see in the second half of the year is probably a much better operating environment, and a more consistent spot market will help support contract rates that they may not be up significantly, but they might be up enough to kind of counteract the inflationary pressures that a lot of carriers are facing, whether it's on equipment, whether it's labor or insurance or maintenance.
So a couple of things I want to pick up on. You mentioned the freight recession. Noel Perry, Noel as an economist following freight transportation, and he looked at some of the demand data, and I think it was the Morgan Stanley data. He was suggesting that after adjusting for the COVID berserk nature of the bubble, he really saw that we're not really down relative to the last 10 years because the bubble was so big, right? We're about average with the last 10 years. So I know it feels like I have this conversation, and it's I don't know, maybe it's esoteric, maybe it's, but I have this conversation often that it feels like we're in a recession because it doesn't feel the same way as it did. But the data seems to support that we're about where the average is, or where maybe equilibrium is.
Mhm.
What do you have any thoughts on that?
Yeah, I mean that's when we're talking about the difficult comparisons. That's what we're really talking about. Depending on, excuse me, which sub market you're in within the freight economy.
Yeah.
Peak earnings was 21 or 22, and it's going to take a long time to get back to those earnings for a lot of companies. That was once in a lifetime environment for a lot of operators. So I would definitely agree with that. I mean, spot rates are still, I believe they're still above 2019 and 2018 levels. We're not in a horrible place. The problem is that a lot of higher capacity has entered the market. Those people can't, make money. And I don't know if you know this, drive a truck, you probably want to make money. And so, and you can only operate for cash flow just to pay, your lease payment or your loan payment for so long until you need to, actually put food on the table. And so a lot of that capacity is going to leave the market. So yeah, I would concur with that. I don't think, we're in the a recession really is, when you talk about recession, it's just negative growth, right? So we're not talking about a depression. We're not talking about like, it's a horrible world. I mean, intermodal volume, which obviously has a lot to do with global trade, and but those containers flow into the supply chain, and a lot of trucks will haul, those containers or get transloaded into 53-foot trailers. But the reality is that intermodal is down 10%, year to date. So that's a big number. It's a big number because it's off of peak. But when you built a supply chain around a lot more volumes, and that volume falls off maybe a lot quicker than people thought, really just puts a lot of pressure on people's finances that are operating in the freight markets, and you're seeing that across the board. Some industries have been a little more resilient. The rail industry, most of the Class 1 rails, except for Canadian Pacific, beat expectations this quarter, where it was more of a mixed bag on the truckload side. It was about 50-50 about meeting and coming short of on expectations. And then on the LTL side, you had Saia and XPO, beating expectations, and the rest kind of falling short. And a lot of that has to do with on the demand side. LTL rates have been more resilient than on the truckload side. They still have, a pricing power. I mean, that obviously that industry is a lot more consolidated than the truckload industry. And you're just seeing that weakness in the spot market just trickle into other truckload categories.
Uh, Thank you. Just a quick reminder for the folks. We've got about 3 more minutes of kind of dialogue here before we go into questions. So again, use your Q&A function. I wanted to follow up on clarification. You mentioned what Derek Leathers mentioned. The spot rates are 13 to 17% below operating costs. Did he mention, or did he qualify? Did he mean motor carrier operating cost or the owner operators operating costs? Because those are 2 different things.
Yeah, I think it was the owner operator costs that they were talking about.
Yeah, and we saw, as you're aware, and a number of the folks on the call are aware, we through our qualifiedcarriers.com company or service, we track all the numbers of drivers, the number of carriers, the number of tractors, trailers, all. And yes, what happened throughout those 3 years is after the bust in the first few months in 2020 when we closed the world down, and we came back from that fall period in 2020 right through the end of this past year and into January's numbers as well. We saw numbers of carriers overall increase. We saw a number of drivers overall increase. And as of the close of 2022, we saw something to the effect of 54% of all drivers driving for that 1 to 100 truck size fleet. The average size fleet of that is about 5.2 trucks, so really small. So we're talking about is most of the growth, and even month on month we see 500 or 600 new entrants. There's a lot to unpack there, right? Some don't want to drive for the larger fleet, some want to drive for themselves. They saw the spot market. any variety of things we could talk about for 45 minutes at least. But in every one of the capacity crises before, we saw the same run up. And it was kind of a quick run up. And it's a natural thing that, and we've been professing this for a long time. If you don't have customers, if you're a motor carrier, owner operator or larger, you don't have customers and you're relying purely on brokerage, purely on the spot market, you're the first one to go out of business. And it's sad, but it's inevitable. That's our experience. That's what we preach. Is that what you see as well?
Yeah, and especially because the spot market is really dependent. The rate is just always the lowest rate that someone offers, and people offer are willing to accept low rates for various reasons. They might just to get home for the weekend. They need to get us to a certain city, so they don't really care, what they're making. They just need to get home from for a family member or something like that, or family commitment. Yeah, I would totally agree with that. It's really about creating relationships, and I would say, I would say, it would be great if you can own the relationship with the shipper if you're a trucker. But I think that, if you build strong relationships with the brokers themselves, that could behoove them. If you're a carrier that has great on-time performance, and is a great asset for that broker if you can make yourself that asset.
Yeah, it's an unfortunate. I think in every, we live in a market, and love it or hate it, when that market overreacts, over responds, there's a corresponding leveling out and a sweating out of additional capacity. And what we hope, all of us, for clearly participants, is that the economy is strong enough to support even an overbalanced capacity situation, but it's not up to us. It's a hope. It's the market will take care of that. So we have a couple questions. We have at least one question here, and I'll just ask folks. We're just over that 15-minute marker, so it is Q&A. We have a couple questions, and we'll ask first. Lee, is there any input that you have on hazmat tanker market? Any sense for where that is?
No, I don't really have any insight into that. But what I will tell you is that given the accident in the rail industry in Ohio, I think that there's obviously going to be some new regulations coming, into the market that will impact the rail operators. And I don't know if that, could be a net positive for, people that are operating on the trucking side. So I think it remains to be seen, exactly what might come of that in terms of new regulations. But it definitely seems that, this is one thing, the one thing that Washington can get behind, is, when you see a tragic accident, is try to create some new regulation around it. The rail industry has been trying to put their own suggestions forward. So we'll see if people in Congress want to go beyond that.
Yeah. As a brokerage, as 3PL, one that serves the energy industry quite a bit, especially in the open deck permitted load side, we get asked frequently if we can help out finding capacity. So we're keenly aware that there is, as Lee said earlier, pockets of this industry are, impacted differently. That is one that has been consistent in my 32-year career. It is it's a tough one to find capacity if you're out. What is your peak 2023 season outlook? Do you have one?
Well, yes, I do have an outlook on that, and I think it's going to be more normal than we saw in 2022. I think in general, a peak, it maybe is, the bad words, more of a hump, if you will. So, not expecting like, a huge increase in demand, but, a gradual seasonal increase in demand. And some of that's being, in our view, going to be driven by, retailers' ability to take take down their inventories. They've been doing that for about a year now. And so, I think inventory levels are in a much better position. I don't think they're where they need to be, but they're heading in that direction.
Yeah, that's one of the questions that someone asked. And do you have an estimate as to when you think those inventories may be back to where folks want them to be?
And I hate to say this because I hate when other people say it to me, but probably in the second half of the year. I know it's probably broad, and I'm not trying to kick the can down the road or be overly optimistic, but I think that they can get down the second half of the year, and people have to remember, inventory levels are high, not necessarily, because people bought, companies and retailers bought too much because supply chains were so clogged up that they were having stockouts or they couldn't manufacture things. So as soon as something was available, they just, were just gobbling things up, and then all of a sudden demand stopped or slowed down considerably, and so people are just stuck with that inventory, and they're just working through it. There are some industries where inventory really isn't that big of an issue, like the automotive industry. There's, if you pass any car dealership, you'll probably notice there aren't as many cars on the lot as there used to be. So there, that's one area of growth. And so when we talk about a freight recession or recession, it may not be widespread. There might be pockets of strength within the overall weak markets.
The question here about, I guess, I mean, how do I phrase this? How should brokers and third-party logistics companies respond to the challenges? I guess what are specifically the challenges for brokers and 3PLs from your perspective? And I can certainly weigh in as well.
Right. So when I look at it, I'm looking at a profitability standpoint because I cover companies like Landstar and C.H. Robinson, and look at other companies like RXO. So when I'm looking at brokers, that's kind of how I'm looking at it. And so their issue is just that margins are compressing, because they're feeling pressure from shippers because they want lower prices. And that sometimes is moving faster than the decline in spot rates, and as spot rates kind of, as mentioning, level off and maybe start increasing, that could pressure margins even more. I'm always a proponent of relationships and strategic relationships. So I think through the cycle, brokers should always build strong relationships with their carriers, trying to get I would if I was a broker, I'd prefer getting better capacity than just squeezing a couple pennies per mile from somebody. And then on the same side, just on the shipper side, building those relationships as well, and trying to provide value in a very competitive marketplace, and that value can differ from shipper to shipper because every shipper has a different value set.
I mean, well said. There's not much I can add to that from the broker side. I agree entirely. In fact, our secret sauce here for so many years has been to build, to cover what we say, to cover lanes, not loads. How do you cover lanes? Well, you build close relationships with carriers. We use owner operators where and when we need to, but close relationship with carriers. They see the business as their own. They see the customer as their customer, and it's really enabled us to scale the business, but also to weather the storms and still get a little bit of capacity, maybe a little bit more capacity than others during the capacity crunch time, because you're in it year in, year out. So I think from a go ahead.
No, I was also going to add, like, if you're a broker, if you're able to find a niche market, and that niche market could be a lane, or it could be a commodity, or it could be an equipment type. If you're able to build a niche for yourself, versus just dealing in the, very commoditized dry van, irregular route kind of market. I think that is something that, should be a goal for most brokers that are building a business.
Yeah, no, 100%. There's a tremendous amount of competition out there, and more and more every day. And with digitalization and the way the markets are moving, and our understanding of what prices should be from almost every point to point with technology, it gets harder and harder. So yeah, you've got to differentiate. So much of what we do now is not really just the move from A to B is tip of the spear. There's whole kind of work on the front end, the planning and the execution and the follow-up, the documentation and rescheduling and OTIF compliance and everything else. It's become a lot bigger than it was when we started our company in 1961. I'll say this and ask you how accurate you think it is. Speaking of since 1961, we've seen every cycle since the Kennedy administration here at Tucker. And what's interesting is, really since deregulation in 1980, we've only had a relative handful of capacity crises, and almost all of them in the last, 2003, but all of them in the last like 10 years, 8 years really. So they seem to be coming more frequently. And any lessons that we can learn in terms of building durable supply chains from what we've seen and experienced?
Well, just the nature of the truckload business it makes it very easy to get in and out of the market. And I don't mean to minimize, people going out of the market, but it's very fungible in terms of, you just need a truck, and you might have that truck already in your driveway. And, if some people would prefer to drive that truck, some people will prefer to park the truck and go do something closer to home. So because of that, I don't think that you're ever gonna have a steady supply. And sometimes supply ramps up too quickly when demand is up, like we saw during the pandemic. I personally think that because the ease of going in and out of the market, the cycles will be shorter, meaning that there'll be highs and lows quicker. And I think that's the way that the market is going to hash out. Until unless all owner operators become unionized, which I don't see ever happening, or it's just going to be tough to set a minimum rate, because the market will set the minimum rate, unfortunately. And then, when times are great, owner operators weren't complaining, when rates were, $5-6 in some lanes, So it's a market that giveth, and a market that taketh away.
Yeah. And that's something for all of us to remember too, is, I think one of the reasons we haven't seen, quite the quote unquote bloodbath in terms of bankruptcies over the last 2-3 capacity crises, and then the day after, so to speak, is that there's a lot more technology out there. There's a lot more visibility into what rates are in the marketplace. And I think that even the owner operators are slightly better capitalized in today's economy than they were a decade and further back. So I think that's a little bit of and again, to your point, a little easier to get out of the out and back in when things get good. So that flexibility is good. It does create it lines up the next capacity crisis if you're a shipper or broker. So you really do have to think about, how do you balance this out over time? And I think, speaking of time, I think we are out of time. So Lee, I appreciate you being here again and sharing your insights. Again, the next date that we have, and we'll send a reminder out soon, is July 13th. Again, 15 minutes plus 15 Q&A. And if you have any ideas for a future webinar, a future a topic or a speaker, please don't hesitate to reach out to us. Lee, thank you very much. Enjoy your
My
rest.
pleasure, Jeff.
All right. Thank you everyone for being here, and see you next time.